I think this next phase, so the next bull market or the next business cycle, will see a mass onboarding of institutions. It's almost impossible for retail investors to continue the pace of adoption. It needs the institutional capital as well, which drives out the ongoing adoption curve. So, my view is still by the end of this cycle, the space is probably 10 trillion plus. And that happens because of the institutions coming to the space, offer more products to their clients. So institutions coming into the space tends to mean that BlackRock offers a product to their network of advisors. So it allows more money to come into the space via different mechanisms.
Real Vision founder and chief executive officer Raoul believes we are drawing closer to the next blow off top crypto bull market. Unlike previous cycles, Powell expects that the coming cycle will be led by institutional investors such as pension funds, family offices, and other big money investors, and that their involvement in the industry will make crypto into a $10 trillion asset class. During a recent interview with the Binance YouTube channel, the Real Vision boss discusses the renewed interest of institutional investors in cryptocurrencies and other digital assets. According to Powell, the digital assets market and industry is a completely different scene for institutional investors. Unlike the traditional and more familiar stocks, bonds, and commodities markets, there's a lot of volatility in the cryptocurrency industry. Powell explains that the volatile nature of the crypto industry is because it is still so early in its growth cycle, especially compared to traditional asset classes like equities and commodities. Powell notes that institutional investors have come to realize that volatility is not such a bad thing. In fact, the former Goldman Sachs executive describes highly volatile assets like Bitcoin and Ether as remarkable portfolio diversifiers. He adds that highly volatile assets can dampen the risk of the overall portfolio over time and give bigger upsides. Volatility or not, Powell is convinced that institutional investors are now ready to flock en masse into the cryptocurrency industry. Other things that may keep institutional investors off include regulatory clarity and the liquidity of the cryptocurrency market versus things like stocks and commodities. But Powell says these big money investors are rising above these things and getting more involved in cryptocurrencies to save their wealth from the constant debasement of fiat currencies. We will now bring you clips from the interview as the renowned macro analyst discusses macroeconomic shifts that have influenced the crypto trading strategies of institutions, as well as what increased institutional adoption will mean for crypto asset prices. As we bring you important highlights from the interview, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Also, ensure you drop your comments and observations in the comments section below. It all helps with the YouTube algorithm and contributes to the channel's growth. Thanks and enjoy the video.
Well, in terms of what is driving institutions to look at crypto, I think they understand the issues of the financial system. I think most people understand how much debt that there is. The US, the largest economy in the world, the government's over 100% of GDP in debt. The private sector is another 120% of GDP in debt. The financial sector is another 200% of GDP in debt. The world is 400% of global GDP in debt. I mean, these are staggering numbers. The world has never had this much debt. They are also aware that that brings fragilities. We see endless banking crises around the world that roll on and on and on because of this very issue. And then they became very aware of monetary printing and the impact that that has as well. So almost every institution that I speak to, whether that's a hedge fund or a pension fund or an asset allocator of some sort or a sovereign wealth fund, understands this. So the question they then ask themselves is, how can we not have an allocation to crypto? So by the time they got to that point, because these are slow moving and they have a lot of work to do internally to get the approvals, what you tend to find is the cycle ends and everyone's like, whoa, they kind of are aware of the volatility. So I don't think it scares them as much, but they just now want the confirmation that the volatility is out of the way and the next phase is coming. So that was the big thing that I saw in this cycle versus the previous cycle. The previous cycle, we saw some participants coming on, people like Fidelity. They started to come into the space. Some of the bigger hedge funds like Brevan Howard had come into the space. Soros, More Capital, these giant hedge funds, they all explored and invested in the space. This time around, the 2021 period, pretty much everybody did the homework. And you'll have seen it at Binance. Everybody's seen it. They've all had a lot of conversations with all of these people. Family offices became much more involved this time around as they understood it. How can they preserve wealth in an environment where the central banks are printing currency? How can they preserve wealth in an environment where you don't know if you could hold onto your assets if a banking system goes under, that kind of issue. So we've definitely seen that. We've seen the rise of, on the trading side, we've seen the rise of more traditional hedge funds investing in this space. So the large asset gathering hedge funds have all traded in the space. They're still not yet comfortable with the volatility. Some of them are, some of them aren't. Others span off whole hedge fund units like Brevan Howard. So Brevan Howard Digital is a giant in the space now. And I think we'll see more of that because the return profile is different and it's harder for the regular investor to get, if not the book is quite small. But we're definitely seeing a lot of interest from that. They pulled back a bit because of the bear market, but that's their job. Their job is to allocate assets. They don't have to be crypto believers all the way through. They need to be gunslingers who look for capital opportunities. But most of those have done the work and will come back into the space. The crypto hedge funds, there's a lot that always launches at the peak of the cycle. And then at the bottom of the cycle, a lot of them don't work, but the better ones survive and thrive. And we see higher and higher quality people coming out of the traditional hedge fund industry and out of the top investment banks like Goldman Sachs come into the space. Then we've got on the banking side of the equation, all of the big banks have large crypto teams, not yet so much for trading, but building blockchain technologies, the securitization of, putting assets on chain, but also ready to make prices, to market make, to offer products to clients. They're all doing the work as well. So I see all these. Well, I know it's very difficult for most people because all they see is price go up, price go down. But I see what's going on behind the curtain, and this freight train of everybody moving towards this is happening.
With the coming halving event in April 2024, there are going to be a lot of potential opportunities for all categories of investors, whether retail or institutional. According to Raoul Pal, institutions like BlackRock are now properly positioned to enjoy these opportunities. When asked how he thought investors were reshaping their investment portfolios to realign with the cryptocurrency market and environment, Pal explains that it has been an ongoing exercise since 2021 when most of these institutions first tested the waters of cryptocurrency investing. Since then, they had time to brace against the volatility and build strong teams of experts who are more familiar with navigating the very turbulent waters of the crypto industry. During the interview, Pal also discusses how the influx of institutional investors like BlackRock and their big money clients will impact crypto asset prices during the next bull markets. Here are more clips from the interview.
I think they've done a lot of the preparing. They've got kind of approval to allocate. Many of them put their toe in the water in 2021. There was a lot of institutions that got involved, and really they were in the learning stage. And what I've found is a lot of those institutions have now built large teams, looking at what they can do about, like, even tokenizing their funds as well. We've seen people like Franklin Templeton building out huge teams to do that. Fidelity have built out huge teams. So there's lots of people doing that. The next phase for these guys is, okay, we understand it. How the hell do we implement it? And this is where it gets harder, because they then have to go and say, okay, do we need to open a multi-sig wallet? Do we want to hold it in an exchange? How do we do this? And obviously there's no ETF, which is one of the things they're waiting for, particularly the investment advisors and the smaller pools of capital. They don't have a vehicle that's easy for them to pass their traditional risk management systems because they're not used to self-custody assets. Right? There's not many self-custody assets. Most of them don't self-custody gold, even though they may have gold. They use the ETF as the easier way to proxy because they don't want to self-custody. So they're all figuring out what the way to do this is. Many of them did VC. So we saw record amounts of VC, 65 billion over 2021, 2022. So that was their way of getting started. Now the next phase, I think, is the more liquid markets. So some own Bitcoin directly, for example. Seen that a lot of family offices do, Bitcoin, ETH, and a bunch of others. We're seeing that. I think we'll see the rise of new products, which is stuff like ETFs. I think we'll see a rise of a structured products market. Now there's more of an options market. So we will see these guaranteed products that have been very common in Europe and Asia over a long time. The next phase, I think, that is very interesting is this time around, they now have an asset that has a yield, which is ETH. And so they can have a yielding asset that also has the risk return profile of technology. So it's a very interesting thing for them to do, because if you're a pension fund, you actually need a yield to pay the pension payments. So it becomes very interesting for them to have an asset, unlike gold, because gold doesn't have a yield. It has a yield. Most tech stocks don't have a yield. So I think there's a phase of people now looking into, okay, how can we hold this asset as well into our portfolio? What does yield in crypto mean for us? It's likely to mean a higher ability to own assets in the space. I think this next phase, so the next bull market or the next business cycle, will see a mass onboarding of institutions. I've seen this space before. Usually it's the family offices are first to take risk. And we've all seen that in the space. Many family offices were the first to invest because they're freer to do what they want with their own capital. As I said, most of the institutions have done work, including the investment banks. And so now they just need price confirmation and then they'll be in. So I think we'll see a lot of that. Now, that kind of makes sense because the asset class at peak was 3 trillion in 2021. It's almost impossible for retail investors to continue the pace of adoption. It needs the institutional capital as well, which drives out the ongoing adoption curve. So, my view is still by the end of this cycle, the space is probably 10 trillion plus. And that happens because of the institutions coming into the space, offer more products to their clients. So institutions coming into the space tends to mean that BlackRock offers a product to their network of advisors. So it allows more money to come into the space via different mechanisms.
Raoul Pal's predictions for a blow-off-top crypto summer in 2024 is a sentiment shared by many other prominent individuals in the cryptocurrency space. A few days ago, the co-founders of crypto analytics firm Glassnode took to their jointly operated Twitter X account to explain that they think Bitcoin could hit a new all-time high in the coming months, faster than many analysts are predicting for the leading crypto asset. According to Jan Happel and Jan Alleman, two of the brains behind the analytics firm, the US dollar index, the XY, is close to its peak. Happel and Alleman expect the dollar to peak at 106, setting the stage for what they describe as a prime Bitcoin environment. The August 21 post reads, Bitcoin's last consolidation phase. The dollar is expected to peak at 106 level, setting the stage for a prime Bitcoin environment. Up next, Bitcoin aiming for $37,000 before soaring higher in the autumn. In another post, the Glassnode co-founders share a chart projecting that the leading crypto asset will hit a new all-time high of over $144,000 by early 2024. What are your thoughts on Raoul Pal and the Glassnode founders' predictions for Bitcoin and other crypto assets? Do you agree that buoyed by billions of dollars from institutional investors, Bitcoin will surpass its present all-time high in 2024? Please drop your comments, observations, and predictions for the leading crypto asset in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.